Good morning, everybody, and welcome to our August IFRS and Corporate Reporting webinar. Now, this month we're looking at a real hot topic, and that is accounting for technology and software costs. If I only had $1 for every time somebody asked us about, can you help us with technology and software costs? Really hot topic. I have with me my fellow IFRS and corporate reporting partner based here in Melbourne, Dean Arden, and he will be exploring this. I'll do a bit of an introduction, but he will do the heavy lifting today. So good morning, Dean. Good to see you.
Good morning, Leda. Good to see you as well. Hope you're well.
I am well, Dean. I'm just freezing, as you can see. I've got my puffer on, and I'm not actively promoting the logo on my jacket. It's just my daughter works at that particular store,
Okay.
and every birthday and Christmas, that's what I get from her. Right? I suspect she gets it at a good price. But anyway, I'm not complaining. It keeps me warm.
Win-win for everyone. Excellent.
It's a win-win for everyone. At least I'm getting a gift for Mother's Day, birthday, etc. It's the small wins. Um, so BDO acknowledges the traditional custodians of country throughout Australia and their connections to land, sea, and community, and we pay our respect to their elders, past and present, and extend that respect to all Aboriginal and Torres Strait Islander peoples. Now, as you know, because you are here today, we do monthly IFRS and corporate reporting webinars. Today, rightfully, is in bright red because it's a hot topic. But then next month in September, Kevin will be back. I'm very sure of it because he loves impairment testing. We'll be looking at tricks and traps of impairment testing. October, Dean, you and I will be all over accounting for Australian carbon credit units as we run up to the first mandatory sustainability reports, 31 December. November, getting ready for 31 December. What are the latest standards developments? And then we'll end the year in December where we look at the tricks and traps of fair value measurement. So it's a busy schedule. Um, then we also want to flag, and to me this is really important. Um, we've Dean in particular have written a number of articles over the last few months around the importance and the value of preparing position papers. Now, many of you will have 30 June year ends, and you will currently be dealing with the finalization of your financial statements for 30 June 2025. You will be dealing with your auditors, and that's where position papers are so important. In those articles, we've tried to explain how ASIC deems position papers and why it's important, how we can help. So really what we believe at BDO, and, if you believe otherwise, please let me know. What sets us apart around position papers and IFRS and corporate reporting is that we combine technical excellence, people like Dean, Kevin, with genuine engagement. We like to speak to our clients, partner-led, and understand what the issues are and come up with a practical solution that's still compliant with the standards. We do want to understand your business, your reporting goals, and tailor our advice accordingly, still compliant with standards. We are focused on practical compliance solutions, and we will provide you with honest opinions. And then, in our team, the motto is high quality. We focus on high quality work, timely advice, and accessible position papers that you can put in front of auditors. We believe in direct access to partners, a personalized experience without the premium price tag. So you can see a few of our initiatives that you might see in the market at the moment. Tired of paying more for less, direct access to our experts, high quality insights, get it right the first time. So you want to look at the IFRS advice and get it right, robust, concise, independent. independent from your auditors. And then also, in a world of uncertainty, judgment matters. And there's a lot of grey and there's a lot of uncertainty, but how do you apply your judgment, and is that still compliant, and how do we document that so we have it ready when the auditors arrive? And this applies to IFRS accounting standards and IFRS sustainability disclosure standards equally. So I just wanted to articulate there's a link where you can click and look at the people you can contact. Please feel free to reach out to me, to Dean, or our third presenter, Kevin Frobers, if you've got any particular questions. We would love to speak to you. Then, as you know, sustainability, Australia is world leading. We will be the very first significant economy applying, implementing, disclosing IFRS S2 in Australia. 31 December, our first clients will be reporting. Absolutely first significant economy in the world. Great interest even from the International Sustainability Standards Board. So Sue Lloyd, who's the deputy chair of the International Sustainability Standards Board, was previously the deputy chair of the International Accounting Standards Board that publish IFRS accounting standards. And she was in Australia last week. She presented 2 days of training in Sydney because they are aware that we're the first significant economy implementing their standards, IFRS S2. It was a great 2 days of training, absolutely fantastic, and we'll feed a lot of that through in our sustainability webinars. We've worked through the pillars 1, 2, and 3 over the last few months. I want to call out the July webinar. Again, we like to respond to what people ask us. So today we're responding around technology. Last month in July, although the title talks about climate risk management, we have actually pivoted the webinar and talked about materiality and assessing materiality around sustainability reporting. 90% of the webinar was on that. Sue, last week in Sydney, talked about that a lot as well. And I was thinking there quite nervously, did I get it right? I can confirm I got it right. So, that's a hot topic, and it was in that webinar. And then this month, we're moving on to Pillar 4, where we're looking at my very favorite, measuring your carbon footprint. Talking about a carbon footprint, our next carbon accounting masterclass, which is virtual, is Wednesday the 3rd of September, and I'll presenting it that day. We also have invited a technology provider. Dean, I'm back to technology. I've invited a technology provider that we work with very closely to come and do a demonstration in the afternoon from 4 to 5 of that software, which we also use. So please reach out if you're interested in that. We also have one in December, and we've scheduled quarterly ones for 2026 already. Now, another thing which is around AASB 2 is that we have released a climate-related disclosure checklist, and you can download the checklist here. And in this checklist, there are 149 disclosure requirements under AASB 2. So currently, if you voluntarily put something in your 30 June 2025 financials, it might be the high-level TCFD recommendations. There's 11 of them. Good starting point, good stepping stone, but we go from 11 recommendations to 149 next year for Group 1 entities. So there's a checklist. We have a rating scale in there where we try and help you to do some kind of self-assessment, and you can always come to us to assist. This is what it kind of looks like. Every disclosure, what's the disclosure, what's the reference? It's all about AASB 2, and an assessment whether we're compliant, whether it's a partial gap, a full gap, or not rated. And then there's a nice summary at the end out of 149. So you have a bit of an idea where the issues are and what to be done. It's a self-assessment, but we're trying you to do a self-assessment. If you need an independent assessment, please reach out to us. So that's a bit of an introduction on where we're at the moment. Stepping over to the hot topic, technology, software costs. Now, all of us know that in our businesses and in your business, There's a lot of talk about AI. There's a lot of talk about SaaS solutions, cloud solutions, migrating, transitioning to all these amazing solutions. Um, and the question that we get asked, Dean, it feels like daily, how do we account for these costs? Because everybody says we want to capitalize it. We're spending this money because we're going to get the benefit of this for years to come. All right, that's the argument. So everybody says surely we capitalize it. So today we want to look at that. Um, as always with IFRS, the answer is it depends. It depends on your facts, your circumstances, the specific technology, how it works, how you customize it, how you configure it, what other projects are you running in your business to enable this new technology. So we really have to pull it apart. So what I thought I'll do is, or what Dean and I thought we'll do is we'll start with IAS 38, which is intangible assets, because we know technology software, if we're going to capitalize it, it will have to go under IAS 38. Dean, did you want to give a bit of an overview how technology has developed in the 21st century? Really fast would be my summary, but I'll allow you to step through this, the actual developments.
Thanks, Aletta. I'm not going to go into detail. This slide and the next slide I've just included in the pack to give some perspective. And it's interesting. So we'll come back to the comment that Aletta made before about it depends. Anyone who ever joins IFRIC in any kind of firm discovers that the answer, it depends. They hear it a lot, and it's often a frustrating answer, but it actually often does just depend. A shout out to BDO Global. I've used one of their slides from one of their presentations for this and enhanced it by adding some extra information around it. What I was trying to do is just give you context and try and understand why IS 38 and AASB 138 are particularly challenging to apply in the technological world. As you can see there, in 1998, IS 38 was issued, it was then revised in 2004, and it hasn't been touched since. So it's still a standard that's sitting there, effectively reflecting, in many respects, the technology that was in place, and maybe not even in 1998, even before that. So, and as you can see from then on, things have developed. Now, everyone talks about technology changes. When I was actually putting this slide together, the funny part is that I felt like I was like the graffiti artist, and I had this massive, big, thing to write on. And as I was moving along the spectrum, I realised I was having less and less room, and so I was having less and less things were actually getting to the slide. So I apologise to all those inventors that have created technology that I haven't listed there. I mean, obviously things like gene splitting, driverless cars, other internet search engines. There's lots of technology. I think we're all aware of it, but I suppose to really contextualise it, I just want to make sure everyone understands we are dealing with a standard that is not deep into technology. So as a consequence, we have to think that the standard is not, it's a starting point, it's not the end point. And so, but I'll come back to that point in a minute. If you want to move to the next slide, Aletta.
Dean, the interesting thing, we always have big celebrations when a person turns 21. So IAS 31 is actually,
21.
IAS 38 is actually 21 in 2025,
Mm,
right?
mm. I hadn't thought
The,
about that.
the
That's interesting.
revised
Yeah.
one, the
Yeah.
revised IAS 38 is 21 this year, right? It's
Yeah.
good
I,
age.
I just
Yeah,
feel like that if you threw a party, there wouldn't be that many people who'd be interested in
no,
attending. There's a lot
no,
of people who are just not that happy with it. So,
correct.
but that's okay. I'm a fan, and I'll happily put my hand up and say I'm a fan of the standard, even though it's a bit old. But that's cool. What I've tried to do in this slide is bucket, and I suppose I'm setting the scene again here by bucketing and Aletta's and Kevin's and probably a lot of IFRS technical people's experiences with working with clients on technology and SaaS implementation and various other things. And what I've tried to do is bucket here they're effectively the givens, but they're also probably the frustrations that we are challenged by when we're trying to apply a relatively old standard to a relatively novel and new situation. So conceptually, I can sort of see three things. So research and development activities, and what are they in 2025? If you read the standard, it sounds like all the research and development goes on in a laboratory out the back of the building. So there's this whole notion that it's sort of separate from the business. It's not a part of it. it's not, it's captured separately, but that's not how it operates now. Obviously, technology development, application, implementation, it's business as usual for a lot of entities. And so conceptually, the standard struggles a little bit there. And one of the things that I find talking to clients, particularly as an issue, the concepts and language. Now, in IS38, the language and the concepts are very dated, and as a consequence, we can't use them when we're talking to IT people about things. Like, we have to extrapolate, we have to think about extending the principles and understanding how do they apply today? What's the basic principles of IS38, and how do we apply them in a practical situation today? Like, I don't think if you use the words customization and configuration to an IT person, they'd probably go, well, I've got 4 versions of customization when I think about it. There's 4 different things that I do under that heading. So language is really important, but it's not the language that necessarily IT people use today. The third point there is that there's always been in the accounting standards this distinction between physical and intangible assets. And so, as you imagine, the criteria for recognising intangible assets, it's a higher bar that you have to get over. When you look at internally generated intangible assets, there's a whole set of criteria, and we'll touch on them. But you have to go through those criteria to meet and therefore recognise costs as assets. But you don't have that same criteria for property, plant, and equipment. So practically, I just Googled the other day and just sort of said, who's the top 10 companies in the world, largest 10 companies, and 8 of them are there listed, and all of them are technology based. I think there was one in luxury brands, and I can't remember what the other one was, but all of 8 out of the 10 top companies in the world are technology based companies. Notwithstanding, Visa is a finance company. I mean, its business is very technological based. One thing we experience constantly is the issue about communication between finance and IT teams. IT teams, if they're not using the same words and they don't understand what the finance teams are looking for, they can't give you the information you want. And so you need to work with them. So communication is absolutely king. Sometimes you have to go and sit in a room with them and actually understand what they're doing and why they're using the phrases they are. But fundamentally, there is a communication thing that we've always had to struggle with. The last thing I'd say there is that entities assets comprise both their physical assets and the tech assets. But I think, if you look at the top 8 companies up there, the more customer contract becomes seamless and assimilated into their online world, the less physical assets matter to the business strategy. And what I'd do is to say to you, okay, let's think about the way that technologies could potentially become seamless in your business. Imagine if Google was a bank. Imagine instead of applying for a bank loan, you just got on Google and you applied for a bank loan and someone gave you a bank loan that way. That would change the way that whole industry operates. So you can see how transformational. I mean, I don't think I'm sure I'm preaching to the converted here, but you understand that technology is transformational in the way some businesses do their business. And so we can't really, we can't look at technology as like it was looked at in IS38 or how it's perceived in IS38 in some ways. It can't be looked at as separate. It has to be actually thought about as a part of your business. So I suppose my key point there is to understand that the standard is a base. And if you are actually in this world, you have to think about, for example, accounting position papers to get you to a point where you can actually explain to your auditor how you're actually applying these things in the current setting. Aletta, do you want to add anything to it?
Yeah, Dean, I think in our experience working with clients where we investigate it depends, actually meeting with the IT team and
Hmm.
understanding
Yep,
exactly what technology, what software they're using. Is it off the shelf? To what
yep,
extent do they customize it? To what extent do they own the
yep,
customizations? To what extent those things that they customized can they also use for other software systems so it's really theirs? What are
yep,
the people and the processes that they redesign, and what cost do they spend on that? Because that's cost too. There's value in
yep,
that too. So really
yep.
unpacking that communication, absolutely, communication is king, Dean. Absolutely agree with you. Um, I might quickly give you a IAS 38 refresher. Now, this is the standard that since it's been revised is 21 years old. And when I talk through this very quickly before I hand back to Dean, um, you will see that it's outdated kind of terms, and it's not really kept up with the times. So if you look at intangible assets, they talk about the intangible assets have to be identifiable. And what do they mean by that? Separable, contractual. They also have, you know, it has to be controlled by the entity. So controlled by the entity, you'll hear a few times today. It is the power to obtain future economic benefits from that resource. And usually you have a legal right to obtain future economic benefits, but it has to be under your control. Um, and then, you know, what does that mean? And then without physical substance, it's intangible. And some of the examples they give us in the standard is we've got computer software, patents, copyrights, fishing licenses, customer list, to name a few. Um, you know, and you can see the ones that we've got there with the red asterisks are the ones that even the standard in 2004 said are unlikely to meet the IAS 38 criteria. Um, but sometimes, although you don't um, recognize them separately, if there was a business combination or an acquisition transaction, it could end up as part of the catch-all category, which is goodwill. So these are some of the key things that will come back today. It has to be identifiable. It has to be under your control, your entity, and without physical substance. Um, and then if you look at, first of all, in the standards, as the old standards are written, there's always definition, what's an intangible asset. It's not a comprehensive list, but it's a starting point. And then they go on to recognition criteria. Recognition criteria, when do we include a debit and a credit? When do we book a intangible asset? When do we capitalize an intangible asset? So once it meets the definition, when do we recognize it is a separate thing. And here it is, does the item meet the definition of an intangible asset? We might say yes. And then we get to, is it probable that the expected future economic benefits that are attributable to that intangible asset will flow to the entity? So we'll look at probability. And then finally, can the cost of the asset be measured reliably? Now, I just want to say this, measuring the cost reliably in accounting, and more day by day, there is an expectation that everything can be measured reliably, because you can estimate more or less anything. And over the years, we've gotten used to that concept, because you can estimate expected useful life, you can estimate fair value of derivatives. You have to put in your best endeavors and come up with a value. So measuring reliably, it's very hard to say you can't measure it reliably. Often with intangible assets, it's about timesheets and adequate record keeping. You can do it if you put in a bit of effort. So really it comes back to the second one. Is it probable that expected future benefits that are attributable to the asset will flow to the entity? So that's kind of three thresholds to recognize an intangible asset. And if you fall out of any of them, you know, you consider, is there another asset that I could potentially apply, or another standard that I could potentially apply, which is often a hard question to answer. But usually you end up that you expense that item. So we have to start with these recognition criteria. So if you look at that initial recognition, we look at the definition. If you meet the definition of an intangible asset, it can only be recognized if it's probable and you can measure the cost reliably, right? Shorthand. And then if you look at probable, it's not defined in IAS 38, but usually we consider it to be more likely than not. So probable is usually that more than 50% more likely than not. And then also this test, and this is important when we look at customization cost, this test for the definition and the recognition criteria, the probable and the reliability, has to be assessed every time you incur more costs. So every time you incur
Seems like Avita might have just dropped off for a minute, so we'll keep going. So every time that cost is incurred, you basically have to redo that test. You have to actually understand it. You back with us, Lou? And so
yeah,
it's not
correct.
a
Thank you. I think.
You there, Aletta?
Yes, I'm here, Dean. Sorry, I saw the internet went and I tried to get it back.
Well, you're back on. Do you want
Thank
to continue?
Yeah, thank you for picking it up,
Yeah.
Dean. Really appreciate it. I don't know what was going on. So, every time you incur that cost, you have to think again if it's probable that there'll be future benefits and whether, we can measure it. Very important, it's not a policy choice. So it's not a free choice. You have to meet the requirements. These are the hurdles you have to meet, and then you can capitalize. So it's not an accounting policy choice, which some people um, wish it was. Um, and then if you look at that initial recognition and measurement of the intangibles, initial measurement. So let's say I've met the definition and I've passed the recognition criteria. How do we measure it? It depends, right? Favorite word today, Dean. It depends whether it was separately acquired, whether it was part of a business combination, because then we'll fair value it. If it was acquired by way of a government grant, so there's a potential interaction with IAS 20, whether it was exchange of assets, separate rules, or if it was generated internally. So internally generated intangible assets, that's where we go and look at the research and development cost kind of criteria in IAS 38. So the measurement depends on where it comes from, how it was generated. Usually initially recognized at cost, so the cash or the cash paid, or the fair value that you've given in exchange for it. So if it's a business combination, we measure fair value. If you've acquired it separately, what did you pay? Um, and then also we would look at if the nature of the consideration is governed by another standard, you would go and look at that standard. Maybe the consideration was not cash, it was actually a share-based payment. Then we have to go and look at IFRS 2. So you can see that it depends is quite far-reaching. So it depends how have you acquired it, it depends how you've paid for it, and the interesting interaction between different accounting standards. Now, as I flagged on that previous slide, internally generated intangible assets, this is where it gets really interesting. This is where you have to look at, do these costs relate to technology or any um, costs that are still in a research phase, or is it in a development phase? But it's even not that easy. If it's in a research phase, we've got a little bit of an explanation what that means, but research phase, fairly easy. If it's costs that you incur in a research phase, um, you expense it, end of story. But even if your costs are now in a development phase, so we've passed certain, we're not researching anymore. We're now developing a marketable commercial solution based on previous research. It's not an automatic that all those costs get capitalized. The standard still says you have to pass a number of criteria, and only once you pass those criteria, all costs after, emphasis, after that date can be capitalized. So important, if you look here on the left-hand side, research, you expense. Right-hand side, you could be in development phase and expensing costs. Because only once you've met all 5 of these criteria can future costs after that date, be capitalized. So very important, if you've expensed something as part of the research phase, or if you expense development costs before you meet the criteria, they're gone. They can't reappear and be capitalized at some stage in future. Um, so, Dean, I don't know if you wanted to maybe pick it up from here, where we start to bring it back to the IFRIC decision.
Yeah, sure. You sure? I might just go back to the previous slide just for a second later because I was going to. There's some
Yes.
interesting things in. Oh, actually, if I go back another slide, so the distinction
Yeah.
between research and development. Go back to what I said originally. If costs associated with technology and development of technology are business as usual, practically we often don't have research and development phases. Often there is, pre-project sort of considerations, and then there's project considerations. Like, so I'm just drawing everyone's sort of attention to the idea of the wording for a start, like the idea that the old, and I'm thinking when I'm going way back when I was in university, oh, there's research, there's research and there's development. Again, it's these are words that we don't think about now. The other one I was going to draw to everyone's attention to, this is just that previous slide, the word in there. There might be a special prize for somebody who can tell me what's the difference between a jig and a die. Now, I'm not only a technical accounting person, I'm actually a bit of an old hand tool nerd. So I know what the difference is, but I suspect that the old language in this standard says more about the standard than probably what it does about our listeners' letter. But you can see there, we don't even. I don't know if there'd be anyone, many if anybody on the call today, that actually know what the difference between those two things was, because we just don't deal with them anymore. They just don't have a place in a lot of what we do. So we'll move on. So accounting treatment of development phase expenditures. I think touched on it. The key problem, and there was a query, I think, from somebody who was one of the listeners today, was sort of giving some guidance around exactly what you include and not include in the costs. I think that the important part is that the principles are very similar to the principles with property, plant, and equipment. It's all about a directly attributable costs. So once you've passed the research phase, you're in the development phase, it's the directly attributable costs. So typically it's your cost of materials, employee benefits, maybe other things you buy, so legal entitlements or legal rights, contracts, patents and licenses. When it comes to people, the important thing is being able to either identify the people that are actually directly attributable or involved in the research, or attribute that, or directly identify the time that they spend on the research. So but in either way, your chart of accounts has to be set up in such a way that you can actually disaggregate those costs in a way that you can identify them with those particular projects. The types of costs that are not capitalisable there are the ones obviously are just not directly attributable to the actual development. So selling, administrative, general overhead, advertising, market research. Now, these might imply that maybe they're going to sell the product eventually in the future, or that might be the case that they're actually just simply keeping the IT to be used for internal purposes. Cost of C-suite time is often one that people ask us about. So, the chief executive officer has been overseeing the project and looking at it, spending an hour looking at the project's development every week. Often we'll say that's probably not going to be directly attributable because that time is not being directed into the project. So that person is probably, they're overseeing it, they're not actually actively involved in it. So overseeing it doesn't necessarily directly identify. There's not a strong nexus between the time spent and the benefits going to be generated out of that project. Do you want to move to the next slide, Aletta? Practical challenges. I just wanted to sort of point, and maybe in response to one of the other listeners' comments about this, is going, well, what do we do? How do we do it? If you'd ask me, I think the clients that I've seen that are best deal with these type of arrangements, they have a very clear understanding upfront what research and development is for them. And they have often integrated that distinction within their wider project management policies and procedures. So you can see them, I'll often have a policy or a document that'll actually say, this is the stages a project has to go through to get to approval, and then this is how it's managed from that point on. Now, the clients I think I've seen that handle the accounting for intangibles well, they have that document already clearly upsigned, so everyone has the understanding, the expectation of where the costs start to be capitalised and when they're expensed. So there's no questions around the actual, there's no internal questions around why am I seeing, assets on the balance sheet at this point in time, because we all agree that this is the way projects are actually accounted for. And I think also the key that is to understand is making sure that and it goes back, and we'll probably cover it a little bit in the next couple of slides, but the idea of understanding what are you buying? So going back to what Aletta was saying before, what are you buying? Are you buying services? Are you buying assets? If you're buying services, then being able to actually identify them, categorize them and actually capture that information. But if they're assets, being able to actually capture that cost information. So having good setup in your chart of accounts, or having good policies and internal policies and procedures to be able to code particular expenditures in ways to ensure that you are capitalising them or expending them in accordance with what you decide that your accounting policy is telling you. So I've put a couple of other things in there. I think the points about IS38 and accommodating agile software, again, that idea, this research and development distinction is, it's not, it's a principle. I think you have to treat it as a principle. You can't necessarily treat it as a hard line, and have to actually make that distinction based on features that depend on how you operate and what you're actually doing. You can capitalise financing costs under certain circumstances. Again, it depends. Can the resource required to conduct a research project be initially capitalised, or they need to be expensed when acquired? Again, depends on the nature of the resources. A good one example, and I think I'll maybe touch on it a little bit later, is so if someone's developing AI, a generative AI model, often what that requires is the acquisition of large volumes of data to ensure that the model works properly. Now, that could be seen as initially as expensed, or you might review it as inventory, depending on how you're going to actually operate. It might be something, but ultimately it's probably going to be expensed. But that initial capitalisation or initial treatment is really going to be subject, again, how you're using it and how does it fit within the accounting standards. You want to move to the next slide, Aletta, unless you want to. I'll quickly touch on Saas, PaaS and IaaS just to give everyone sort of an understanding of what we're talking about. Really just provided that to sort of give you context. So when we're talking about on premises, we're just simply talking about old school. I've got a server in the office. All of our software and all of our data are sitting on that server. It's all installed on that. So it might be a PC, it might be a server, depending on your IT setup in your office. So, software as a service, everyone should be familiar with that. We do it. We provide it as a product. So a lot of our lease management clients would be very, very familiar with it. It's applications delivered over the internet. So you're receiving the access to the software. The software is sitting on a server somewhere. It's not your server, but it's sitting on a server somewhere. You have your own deployment, but you don't necessarily control the actual underlying software, and you don't control necessarily the rights around that software. So platform as a service, again, similar arrangement, except you're not talking about applications, you're talking about frameworks and components delivered over the internet. So good examples being AWS Elastic or OpenShift. I mean, effectively, they're platforms to allow you to do building IT systems. And the last one, infrastructure as a service. So it's computing resources delivered over the internet. So it's, again, effectively capacity. So Amazon Web Services or Microsoft Azure, which we use as well, as a consequence of the way that they're set up, you have access to that capacity, but it's not your server, it's not your arrangement. You effectively, buying the right to have that access. So happy to move on to that next slide. There were two IFRIC agenda decisions that were quite important and quite interesting from the software and the technology perspective over the last couple of years. One was in March 2019. Now the IFRIC, so the IFRIC's interpretation. IFRIC is the interpretation committee of the ISB. It received a query from somebody to say, look, what do I get if I buy supply software hosted on the cloud? Have I got an asset? What is it? And so the IFRIC sort of stepped through it in obviously using IS38, but they stepped through it in the context of IS38 and started breaking that question down. Sort of started with, well, does the arrangement contain a lease? Yes or no? If it's a lease, then we apply IFRIC 16 to it, but recognizing that it's got to meet certain criteria. So, being able to control the software is an issue. If you don't find that you've got a lease, you'd say, well, does it grant you access to the customer, grants you access to software that the customer can control? So do you have actually an asset? Yes or no? If you can't say that you've got a lease or an asset, then the implication is that you've got a service contract, and therefore the implication is that you are paying expenses. The costs that you're incurring are expenses. You are just paying for access. It's not necessarily physically your asset. Aletta?
And Dean, I think the interesting thing is, thinking of, do we have a lease under IFRS 16? There is that magic word of control. And then if you look at IAS 38, there's control again. So often, we end up where this arrangement hosted in the cloud is you've got a service contract, you're right. So you've got, yeah, so it's an interesting one. And but this was a very important decision, and it led to interesting developments afterwards. But it's just
Mm,
for the attendees to make sure that they consider the fact that control is embedded in both those standards.
mm. And they're referring to different aspects of what that arrangement is. So when we're
Yes.
thinking about control in a lease, we're not
Yeah.
thinking about necessarily legal control. We're not talking about
Yeah.
physical control. With control in a lease, we're saying we have the right to direct the underlying services in that arrangement, but it doesn't mean
Yeah.
that we actually physically or legally or any other have
Yeah.
other rights. So it's very important to be clear as to what you control. Those words, just on that point, really, words are really important in this sort of context because, the one thing I have come across when talking to clients about their investments in SaaS and various other software arrangements is that often from an IT perspective, they see it very clearly as capacity. So we are investing in our capacity. It's investing in our ability to do things in the future, which I completely get. I completely support and completely acknowledge. But it's important not to confuse the notion of increased capacity with control, because
Yeah.
control is a slightly different concept. Capacity gives you the ability to do things, but it might be because you can direct certain things or you can leverage certain things at certain times when you need to. Control is a slightly different concept. They might look a little bit similar, but control can be very, very different. And I think if we move on to the next couple of slides, that'll probably hopefully come more obvious. So this is just, again, summary a little bit of the IFRIC agenda decision from March 2019, sort of walking through the notion of a lease. So you can say there, look, is there an identified asset? So imagine if you're using an asset that's through a portal, you've got access to I don't know, customer resource model, and you're basically using that. Do you have an identified asset? Well, you might have a deployment, but you might not be able to actually identify the actual software that you're using. So then you might be struggling to actually say you have a lease because you can't identify the asset. It's not readily it might be presented to you, but the other thing too is keeping in mind if it's in a deployment on the cloud, you might not have your own individual software. You might be using a software that's actually been drawn through the cloud into other arrangements. So I think we're happy to move to the next one. I think so.
Yeah.
So April 2021 was an interesting one because that's when really the rubber hit the road, where everyone was starting to ask questions. Look, everyone who ever goes through an IT transformation, there'll be a lot of upfront costs, and the question was then asked, well, can we capitalize those upfront costs? How do we treat them? Because we seem to be spending a lot of money on getting this up and running. We think that this is going to give us lots of capacity, so we're going to have lots of ability to do things. Can we capitalize it like we do with property, plant, and equipment? And so again, the IFRIC really had to sort of work here because they didn't have any concepts within IAS 38 that were able to leverage to actually help them explain this. And so what they had to do is step out and sort of look and say, okay, well, maybe if we start to think about how the costs are categorized, let's make a distinction between configuration costs and customization costs. So configuration costs, setting the various flags or switches within the application software. So, if it's some kind of, maybe personnel type software, it might be a case of, do you switch on a flag which makes a distinction between certain groups of employees and other groups of employees for, I don't know, superannuation arrangements or something like that. So already with embedded in the software, there's the capacity to do it, but it may be the case that maybe a developer has to actually turn that on or off. You can't necessarily do it at an individual, user level. In contrast, customization costs actually modifying the software code in the application or writing additional code. So what you're actually doing is adding something to what's already there. And you can see these are really simplistic concepts, and I'm sure that someone who's watching this from an IT perspective would probably say, well, that's very simplistic, but that's the way the IFRIC sort of developed their thinking around this to try and deal with the fact that there wasn't really anything in the standard that would help them sort of to understand exactly how to treat the distinction between configuration and customization costs. So I might move to the next.
Yeah, and Dean, I might just call out that you can
Mm,
see that these configuration cost and customization costs both refer to software. So
mm,
it's configuration around the software and the existing code to
mm,
function, and customization is modifying the software code, right? There are other things that could potentially
mm.
happen in order to get a business ready for the rollout of a new SaaS project that's not necessarily linked to the software, right?
Yep.
It's not just to the software, and that's where it gets tricky, right? Which of those costs create future benefits
Mm,
and should be
mm.
capitalized, right?
Yep, and I suppose that's a good part. And then leveraging back what we've already sort of discussed, you can have customization and configuration costs in the same arrangement. our obviously where we're heading when IFRIC or any standard setter makes a distinction between things, then the implication is that those things are going to be treated differently for accounting purposes. So, and this is probably where I'd say again, in response to some of the attendees' questions that we've received to date around this, um, what indicates a successful, or what are characteristics of a successful adopter of accounting for IT is understanding what you're buying in advance and setting yourself up to be able to account for it and capture that information in advance. Um, the one big challenge we found when dealing, helping clients through this process is often they've just dropped everything in a single bucket and they've got everything sitting in their balance sheet. They've just got this mass bucket of costs and they've just said, look, we think we can we can capitalize all of these. If you haven't made the assessment beforehand and been able to maybe distinguish the different types of costs you're incurring, you've got a lot of work in front of you to actually start to carve those things out and try and work out what are they for? Do they meet the certain criteria? Do I expense or do I capitalize? And that's effectively what the ISB sort of then concluded, to saying, well, look, if the customer doesn't control the software being configured or customized, and those configuration or customization activities don't create a resource control by the customer, so it doesn't create maybe, say, for example, code that you get to keep, that's separate from the software, that you can't keep it separate from the software. You wouldn't recognize an intangible asset because you don't control the thing that's driving the benefits. You don't control the software in that situation. Someone else is giving you the software. You've either directed them or they've agreed to modify it in some particular way, but you don't walk away with anything. Like what you get is what that software is at the end, but you keep getting access to that. You don't have a right to the software, just the usage of the software. Alternatively, if the arrangement results in, for example, additional code from which the customer has power to obtain the future economic benefits and to restrict others access to those benefits, then the question is you arguably have an asset in the form of that additional code, but you can now see that the question then is, how do I put a dollar value on that additional code? I have to go back to my original concepts in IAS 38, making sure that I understand what the cost is, and that goes back to, have I planned for this? Have I ensured that I've actually set myself up in a way that I can disaggregate the costs that I've incurred on this total project into the costs that are attributable to that particular part. So who were the software developers working on this? How much time did they spend on it? What's their charge out rate? Those sort of pieces of information, if you don't have them, if you've dropped everything in just into a particular bucket, you are going to struggle to actually be able to, you can do it, but it'll take a lot of work to get that information back out and to be able to demonstrate to the auditor that that is what the asset's worth. Aletta, do you want to add anything to that?
No, I think that's fantastic, Dean.
Oh, okay, excellent, excellent. Now, another trick that the that the IFRIC had to deal with, um, and I feel sorry. I think they definitely earned their money in these two agenda decisions. One of them was when someone come back and said, "Yeah, okay. What if there is some actual work done on that's work done on the software that I pay for separately? Now I don't get control of that software, so it's not an asset that I separately control, but it's actually embedded within the software that I'm. So what's going to happen is in the future, I'm actually going to get benefit from that feature, notwithstanding it's actually embedded in software that I don't control, or it's embedded in a hosting arrangement that I don't control." And so that was a good question for the IFRIC to deal with. And they said, well, there's nothing in IAS 38 that sort of helps us with that. So what they did is they actually jumped over to IFRS 15 and said, let's use the concept of distinct and not distinct to actually make that separation between those things. So the idea that if that software is so embedded in, if that work that to change the software is so integrated or embedded within the software that for example, you wouldn't necessarily get anyone other than the software provider to do that work, then you might argue that that's additional benefit that you paid for, and therefore you're going to get the benefit of that over the term of the contract, and therefore you might amortize those costs. Again, separately recognizing the costs, but being able to amortize them over time to make sure that you're saying, well, this benefit's in there. If alternatively, if anyone could come along and do those services, then it's not integral necessarily to the software. It could be done at any time and it could be done by anybody. Then that concept then saying, well, actually, then you would actually defer and match the costs. And we don't talk about deferring, but the idea that you might capitalize those costs initially, but recognize them over the time that the service is provided, not over the longer period of which the software is being provided. And so, as you can say, we'll go back to the words. It depends. It depends on
Yeah.
everything. It depends on the circumstances. It depends on the nature of it. And so, as you can see, all of these things really driving that. The accounting standard IAS 38 is quite simple in the sense it just sort of says capitalise or expense. There's no, you only have two options. But those two options, underlying those two options, there's a lot of judgments and work often involved in this sort of context because the standard doesn't provide you with it gives you guidance, but it doesn't necessarily give you the great great detailed guidance that often you get in the more recent standards that says in these situations we interpret it this way. So
And yeah, sorry, Dean.
sorry,
I think
go on.
for me, on the right-hand side of this diagram, if we've got configuration or customization services that relates to something that is an intangible asset in our financial statement. So we've made an assessment that the software is an intangible asset. We control that software. If we then configure and customize something that we already control, usually not
Mm,
always, usually it depends. We can
mm,
capitalize that to the
mm.
underlying intangible asset
Yep.
and amortize over its useful life. So the real problem is actually the left hand side on the screen, where you cannot capitalize an intangible asset for the software because you don't control the software. You just have access to the software. And
Yep.
because you don't control it, but you've got access to the software, how can you now capitalize configuration or customization services around something that you don't control and therefore you haven't recognized? But it's not all doom and gloom. I think what we're saying, it still depends. It
Yeah.
depends on who provides the service. It depends on whether that service is distinct or not. So, it's not all doom and gloom, but that's where it gets really difficult.
No, no, I agree. I agree. And the interesting thing too is that, and maybe to give it a bit more context in a social setting, um, imagine your auditors coming and looking at your IT, expenditures and IT projects, and you're saying, I'm capitalising all these costs. Now, the auditor would be familiar with all of what we've talked about to date, but may not necessarily be familiar with what you're actually doing. So they might not be an IT expert by any means. And so when you're saying to them, you need to capitalise, I think the first thing that if I was the auditor, I'd say, well, you're going to have to demonstrate it to me. I don't get how you get to this conclusion, given that there's quite a lot of reasoning behind this and a few steps that you've got to get through. I'm not doubting you've spent the money, but I am doubting whether or not it actually is an asset because there's a lot of it depends. And unless you tell
Yeah,
me about the it depends, I can't get comfort around your conclusion around your capitalisation.
yeah,
And so it's the common one we do get is where clients will come to us and say, I've shown my auditor all of our expenditures and they don't want to be, they won't let me capitalise it. And we say, well, you have to be able to explain to them that it's fair enough too that their position will always often be when they walk in that why wouldn't I think this is going to be expensed if it's, especially if it's SaaS or PaaS or IaaS.
yeah, absolutely.
I've just provided, yeah, look, we just provided that. It's a little bit of a breakdown of sort of some of the IFRIC decisions and a little bit of a flowchart to sort of assist sort of understanding what are the key things you need to think about and maybe breaking up your thinking if you are looking at an IT project and thinking to yourself, how do I articulate in my mind or separate in my mind the different components of it to start with? And then when I've identified those components, then trying to think about what the accounting for those particular components are, then being able to overlay that with your chart of accountants and where you think that your internal processes that you will actually be able to identify and capture those costs with. So yeah, I won't go into detail. There's a fair bit there, but people can actually have a look through it at their leisure.
Yeah, so Dean, I really liked this when because I haven't seen it before.
Oh,
So I really liked it because when I looked at the top, you make an assessment at inception of the SaaS arrangement, whether you've got control and etc. But if you say no, I
mm,
don't have control over the software. I just have access. If I
mm,
go to the right to that yellow orange color, as a consequence of the SaaS arrangement where I've got access, will the entity acquire control of on-premise software to
mm,
use in conjunction with the arrangement? Though that's where it gets
mm,
interesting.
mm,
I have access to the the SaaS software, so I expense in the blue block. But when I get to the yellow block, maybe I do acquire control over some on-premise software,
mm,
which I use with my SaaS software. So
yep,
that part of the software, the on-premise, I could potentially capitalize. But
yep,
even if I don't get that in the gray block, it's, you know, good to have it in gray. As a result of this SaaS arrangement, this access arrangement, important, will the entity develop on-premise software that it will control? So there could be on-premise software that we develop in order to use efficiently, effectively,
mm,
the access to the SaaS, right? So
mm,
it's unpacking that. And,
mm,
if you say yes, again, potentially you can capitalize it. So we really have to pull the software apart.
mm. It's not uncommon to see with entities where they have legacy systems already in place, which they're
Yeah,
relatively happy with, but they're trying to get a more seamless, a more
yeah,
seamless sort of information technology solution going. And so
yeah,
those databases might continue to work in the background, but what they're trying to do is actually get a better handle of that information, get it into one spot, but
yeah,
also being able to manipulate it in a better way. So, and certainly that's been our experience. Our entities that are going through that process, and if they have the internal or even the external resources to sort of say, look, sometimes we need to build some apps or BMIs to basically link up some of this information. In doing so, often there's a bit of software development time and money spent as a consequence. Those things. Now they might not necessarily be, and this is going to that idea of they might not necessarily be cash generating. They might not necessarily be things that you might say, look, I might not be able to use it entirely afterwards. But if you have some other aspects of your arrangements are giving you control over maybe so access, you might be able to still capitalize those costs because they are contributing towards the entire system, which you have some at least ability to continue to access. So again, it's that depends question that keeps coming up. What's your facts and circumstances and how do these requirements apply to you?
yeah. And this software that you have on premise is potentially not only working with the SaaS, it might be working
Mm,
with other software.
yep.
So understanding that. So I think the lesson here, I'm not going to say what the lesson is because you're going to go key takeaways is we have to understand our IT, right? And the software. We have to speak to those IT people, right? Sorry, Dean, I'm stealing your thunder here.
No, absolutely. No, no, that is absolutely key. Like, the key takeaways, and these are really practical takeaways. And maybe they're practical for me, but I think that they're relevant to anyone in a finance team looking to try and understand and how to implement, an account for, an IT transformation process. The first thing that I think, and it's quite odd that we talk about technical accounting stuff, but in fact, one of the key things at the start of all of these types of projects I realise is often missing that is actually essential to most of these projects being running smoothly is an expectations gap and making sure there isn't an expectations gap. So I mentioned before, like IT people often talk about capability. When they use the phrases like capability, what that often means is that's interpreted by board members or similar people in governance where they're saying, well, we're buying an asset. And then the next question is when the management accounts come through, why isn't there an asset sitting on my balance sheet? Well, I've spent all this money on IT, but there's no asset there. Why is that? So setting the scene absolutely up front, making sure everyone understands what you're doing. But as a part of that, you actually need to be step number two, which is actually be proactive and get ahead of the IT curve so you actually understand what's the project. And I'm not saying that you have to be a software developer. I'm just saying that you have to understand what's the objective, understanding what are the things that are going to come out of it, what assets do you think you're going to get, what leases are you going to get, what resources you're going to use, what's your cost going to look like, and being able to actually bucket those things in advance before you actually then start to have that conversation with those in governance to say, this is what the project's doing, but the accounting is going to look like the following. And it's not going to be a case of necessarily all expenditure. There might be assets in there that they don't sort of aware of or that they're not familiar with. So actually explaining those things. Establishing the ground rules really early. I think that's sort of that part of being understanding what is the project, but also having in place. I think I mentioned before the idea that clients that do this well often will have their accounting would be embedded in their actual IT project policies and procedures in the sense that everyone understands all of the activities up to a certain point are generally expensed because they are in research in nature. And then after that point, there'll be a critical point, and it might be where it might be a case where actual providers are engaged and therefore people are actually spending money. That becomes then the development phase, and you start to capitalise from that point. So making sure that everyone's on the same board, but also ensuring that you've got the policies and procedures in place to capture the information. Last and not least, I mean, we've probably always been heading towards this point, but it's actually documenting your accounting policy. So being able to explain after having gone through that process, then being able to document all of this and say, we're going through an IT project, this is the nature of it, this is how we've accounted for it, because of the following things. These things are assets, these things are not, this is a lease, whatever you come to the conclusion you come to. But you can see that having gone through that, if you haven't gone through that, you can't get to obviously, the fourth takeaway. But obviously, if you think to yourself, if you were to present this all to your auditor, the auditor would immediately think, you're not giving me any help here. There's no support. You need to document to me because you know what's going on. But there's no way I'm going to be able to step through all of this and actually understand, particularly there's the judgments and estimates that you're applying to get yourself to where you are. Aletta, I think that might be me.
Yeah, that's fantastic. I love these key takeaways. Dean, IT people understandably don't understand our IFRS accounting standards. And to be honest, us as finance people often don't understand all their technical jargon. So it's that communication between the two teams all along to ultimately put something in front of the auditor.
Yep.
Critical. I also wanted to add that we have issued a newsletter article after the second IFRIC agenda decision because it was a little bit full on and a lot of people were caught unaware. So there's an article that was published in May 2021 that you can read through where we try and explain it as well. And then obviously, if you need assistance, please reach out to us. So we've got our IFRS and corporate reporting team. And as I said earlier, we need position papers, and that's what we do, and that's what we're good at. So please reach out. Our partners across the country, Clark in Brisbane and Kevin in Sydney, Dean and I in Melbourne, Lynn in Adelaide, or Ashley in Perth, please reach out and we would love to help you. Dean also talked about earlier, BDO, our team, actually have a SaaS solution that we make available to our clients, and our clients have access to our SaaS solution. We make it available through Microsoft Azure, and that's BDO Lead. It's our IFRS 16 solution. We also have an outsourced lease management service. You are in busy season, you might have headaches about leases, please reach out. And we also have a new BDO Lead dashboard, which is kind of helping people manage and make decisions about their leases. So if you're looking for a demonstration video on BDO Lead and a bit of an overview, you can have a look at that. These are some extracts around dashboards, which is built on Power BI. We have monthly newsletters and a lot of e-learning that you can buy on our website too. On sustainability reporting, as you know, a great passion. We do carbon accounting, sustainability reporting, and then our auditors provide assurance. And we also have some of our partners looking at the strategy consulting piece. So who do you speak to? In Brisbane, Tom Hockbert. In Melbourne, Dylan and I. In Perth, it's Ashley. In Sydney, it's Kevin. So if we can help you with sustainability reporting, please feel free to reach out. And if you look at assurance, and these are the leaders in the various offices. I would like to say thank you very much, Dean. Thank you very much, everybody. Please keep the questions coming. Email Dean, email me. We do look at your questions that you ask in webinars, and we don't often respond to them directly in the webinar, but we maybe write an article as a result, or maybe we pick it up in next month's webinar. So please send those questions through. Thank you very much, and I hope you have a lovely day. Goodbye, Dean.
Bye, Aletta. Bye, everybody.